You know, every big move a business makes, we're talking building a new factory, launching a product, you name it. It all comes down to one critical number. Today, we're going to break down exactly what that number is, the cost of capital.
So, have you ever really thought about it? How does some huge company decide, yep, let's spend millions on a new factory, or let's buy that other company? It's definitely not a gut feeling or just guesswork. Nope, there's a super logical financial reason behind it all, and believe it or not, it boils down to just one single, really powerful number.
And that number, well, it's what we call the cost of capital. Think of it like a magic number. It's the ultimate benchmark, right? It's the hurdle that any new idea or project has to leap over to even be considered. It's basically the secret yardstick they use to measure whether something will actually create value.
All right, so what is this cost of capital, really? It's easy to hear the word cost and immediately think, oh, that's just the interest you pay on a loan. But it's so much more than that. It's actually a way richer and, honestly, a more fascinating idea.
Okay, let's put that in simple terms. It's basically the break-even point for the whole company. If a new project they're thinking about is going to earn less than this rate, well, it's actually destroying the company's value. But if it earns more, boom, you're creating value. It is the absolute minimum price of admission just to stay in the game.
This really gets at a core idea here. All money has a cost, no exceptions. Let's say you start a business with your own savings. You might think, great, this money is free, but it's not. There's what's called an opportunity cost. That's the money you could have earned if you just put your savings somewhere else, like in the stock market. Now, on the flip side, if you take out a loan, the cost is super obvious, right? It's the interest you have to pay the bank. But the key thing to get is that both of these, they are very real costs.
Okay, look, this isn't just some boring textbook concept. For real, understanding this number is absolutely crucial because, like we said, it's this high-stakes hurdle that every single new idea has to clear.
I mean, this quote from our source material really says it all. It's pretty blunt. If your new project can't make more money than your cost of capital, there's just no point. It's a total non-starter. The company would literally be better off doing nothing at all.
So yeah, this one little number is like a financial Swiss Army knife. I'm serious. Companies use it for everything. Deciding which new projects get the green light, figuring out the perfect mix of debt and equity funding, and even judging how well their own management is doing. It is that fundamental to the business.
Okay, so how do they actually come up with this super important number? The best way to think about it is like a recipe. A company's money, its capital, is made up of different ingredients, right? And each ingredient has its own cost. The whole game is to figure out the blended, total cost of the entire recipe. For most companies, there are two main ingredients in that recipe. You've got debt, that's just money they've borrowed, and you've got equity, that's money from the owners or shareholders. In the example we're looking at here, this company's recipe is 70% debt and 30% equity. So what determines the cost of that money? It all comes down to one word, risk. It all starts with a baseline, a foundation. That's the return you could get on an investment that's completely safe, like zero risk. Then you start adding layers. You add a little extra, a premium, for business risk. You know, the normal uncertainties of the market. And then you add another premium on top of that for financial risk. That's the risk that comes from the company's own decision to take on debt.
And here it is, a simple formula that just puts all that together. The total cost of capital, which we called K, is just that risk-free rate, the R0, plus the B for business risk, plus the F for financial risk. See? It's really just a simple formula for putting a price on risk.
So let's actually apply this to our company's recipe. Remember, we have two ingredients. First, equity. It's 30% of the funding, and its cost is 12%. So its weighted piece of the pie is 3.6%. Then you have debt. That's the other 70%, and its cost is 10%. So its weighted cost comes out to 7.0%. And now for the final step. You just add those two weighted costs together, the 3.6% from equity and the 7.0% from debt, and you get 10.6%. And there it is. That's the final number. That is this company's weighted average cost of capital, or WACC for short. This is their magic number. This is the ultimate hurdle rate they have to beat.
Okay, so we've seen how the sausage is made, right? We know how the number is calculated. But let's zoom out for a second. What's the big takeaway here? How does this actually help a business make the right decision?
Well, it really all boils down to this super simple three-step process. Step 1, calculate your hurdle rate. For our company, that was 10.6%. Step 2,
figure out what you think your new project is actually going to earn. And step 3, compare them. It's that easy. If the return is higher than the cost, it's a go. If it's less, you walk away. That's it. That is the fundamental logic of how to create value.
And you know, that really brings us to the final thought I want to leave you with. This whole idea, it's not just for giant corporations. Think about it. The next time you have to make a big decision, and I mean with your time, your energy, or your money, just ask yourself this simple question: what's the opportunity cost here? What am I giving up by choosing this path instead of another one? Because that's the real hurdle you have to clear.